The Fed does not have an easy job at all. And this feels very uncomfortable, to your point, that this idea that output is slowing, we're seeing a decline in economic growth, but the labor market is still very strong. So the labor market, not just in the jobs reports, but when you look at layoff numbers, still consistently below 1.1%. We're at an all-time high in terms of the quits rate. So basically people are quitting their jobs confidently, layoffs are at an all-time low, and then we're seeing strong job creation. That balancing out with this concept of the Fed tightening into an economic decline is very confusing. I would say the one thing, though, that helps add some clarity to this is everything points back to the consumer, right? So consumer spending is 65% of GDP. What hasn't kept pace with inflation is wage growth. So we're still seeing, in terms of real terms, a decline in wages, which will flow through into earnings, which will start to see some cracks in terms of the economic backdrop. We're starting from healthy levels, but that's something that could ultimately create that difference between whether we tip over into a recession or not.
The two scenarios that you described at the beginning, do you have a probability for which is more likely at this point?
We do. So we still are in the resilient. When you look at, it's roughly 50-50, but we give a small edge in terms of the resilient scenario, which is essentially you're going to see slowing growth, but not tip over into a recession. The reason for that is because we're starting off, the strength of the consumer is still relatively strong. We're coming into this year based on record earnings growth. So some of this change in terms of what we're seeing, we still favor the fact that we could see a soft landing, but it's really going to depend upon the Fed's trajectory from here, which is why we're advocating for very diversified, very balanced portfolios in terms of creating some hedges depending upon which one of those two scenarios happens from here on out.
So you think it's put a foot in the water? How many, like a whole foot, 4 toes? I mean, it sounds like you want to definitely hedge your bets, and you're very selective about what you do, but you're not going to wait for a bottom in the fall. You would be buying right now selectively.
I think what you have to do is depend upon how you are currently allocated. So we had started in actually Q4 of last year. We shifted our portfolio significantly away from some of the high growth stocks into quality. So if you look at an index like the S&P Dividend Aristocrats, so companies that have dividends ranging from 2.5% to 4% that have been consistently growing earnings and their dividends. And then what we did starting in about March is balancing that out with fixed income, quality fixed income. Once we saw the 10-year go north of 3%, adding some of that exposure as a diversifier. But you can see in both equities and fixed income, we're still, while we're fully invested, we're still invested in the quality and not stretching for yield.
Shepard Smith here. Thanks for watching CNBC on YouTube.